When you're trading supply and demand zones, I bet you use classic candlestick charts. But here's an idea. What if you used Heiken Ashi candles? Would it improve your results? 100% yes. Today I'm showing you my unique way to trade supply and demand areas without noise using Heiken Ashi. And if you want to show your support, please leave a like to help us with YouTube algorithm and turn on the bell so you don't miss when new videos are released. The only reason why price moves in any market is because of an imbalance in supply and demand. The greater the imbalance, the greater the move. A strong uptrend can only exist if buyers outnumber sellers. During a trend, price moves up until enough sellers enter the market to absorb the buy orders. The origin of strong bullish trends is called an accumulation or a demand zone. Bearish trends are created when sellers outnumber buy orders. Then price falls until a new balance is created and buyers become interested again. The origin of a bearish trend wave is called a distribution or a supply zone. A demand zone is a price area below the current price action where there is a strong buying interest. Looking at this chart, we can see that there was a lot of buying interest at this demand zone. For this reason, when the price reaches the level, you will notice a sharp price reaction from the demand zone. The supply zone is the exact opposite of the demand zone. A supply area is located above the price action, and it typically contains a relatively big volume of sell orders. When a price action reaches this level, the price reverses to the downside. Now let's introduce Heiken Ashi into equation. Heiken Ashi has proven to be one of the best strategies to use to gain a deeper view of the market, because with these tools, it's easier to read candlestick charts and analyze market trends. Traders use the Heiken Ashi to get information such as when to stay in a trend trade or if it's time to get out because the trend has reversed. I don't want to insist too much on this topic, as I have several videos on this channel explaining how these candlesticks work. Just remember that Heiken Ashi filter noise and help you to see the trend better. So why trading supply and demand areas using Heiken Ashi? As you know, the candles on traditional candlestick chart usually change from green to red, making it difficult for some traders to read them properly. However, the candles on a Heiken Ashi chart display more consecutive colored candles, making it easy for traders to identify past price movements, current trends, and of course, supply and demand zones. With Heiken Ashi, trends usually stay green in an uptrend and red in a downtrend. For me personally, it's much easier to find supply and demand areas using these candlesticks. This isn't the case with the traditional candlestick charts, where colors are different, even if the price is moving strongly in one direction. So how do you mark a supply or demand zone using Heiken Ashi? The idea is to find a place on the chart where demand overcame supply for long trades, or where supply overcame demand for short trades. Step number 1 is to identify the current market price. Step number 2 is to look left on the chart. Then, look for the big green or big red Heiken Ashi candles. Then, find the origin of the big candles. And the final step, mark the zone around this origin. Since the Heiken Ashi candles start from the middle of the previous candle, I had to come up with a slightly different way to mark these areas compared to classic candles. For a supply zone, I searched the last bullish Heiken Ashi candle before the drop. Once you've done this, you need to drag a rectangle up to the most recent high before the drop. For a demand zone, I look for the most recent bearish candle before the up move and drag a rectangle down to the most recent low before the up move. Supply and demand levels can be fresh, it means price has not pulled back yet, meaning an untested level. Non-fresh, price has pulled back to it at least once. And used up, price has pulled back to the level several times, and these are not good for trading full swings, maybe some scalping trades. Plotting these areas should be done with a logical and organized approach. Often, supply and demand traders tend to pollute charts with tens of levels, where the whole meaning of anticipating the rejections loses the value. So try to keep your charts clean. When it comes to efficient plotting of supply and demand zones on the Heiken Ashi chart, here are the main variables that you should follow, which will increase your efficiency a lot. Focus on the freshest supply and demand zones. Focus on the strongest zones, those where price left the zone in a quick, strong manner. Focus on the nearest zones, so don't plot 50 levels on the chart. Have only the nearest one in sight to keep your chart clean. And focus as much as possible on dense zones, where the price was consolidating for a while before forming the zone. The fresh zone always has priority over the old historical supply and demand zone, because the statistical chance for the order flow to be still participating in the fresh zone is higher than in the old historical zone. As the time passes, the traders will slowly liquidate positions over time. That is the fact. Thus, the fresher the zone, the more focus the trader should put on it. Personally, I only plot 3 to a maximum of 5 zones on the chart at most, on different time frames, no more than that. Now let me show you how to find the best supply and demand Heiken Ashi zones to trade. I look for several clues. First, you determine the strength of the move. How did the price leave the level? The stronger the price moves away from the zone, the more out of balance supply and demand are at that level. It means a heavy order is placed by smart money. Here's an example showing different types of zones. The first one is the strongest, with large bearish candles forming after the price left the area. The second one is a strong zone, with big Heiken Ashi candles with no upper wicks, and a few candles having wicks. And the third one is a weak zone, price moving down in an unconvincing manner. This is very powerful, so please remember this part. Number 2. Time at the supply and demand level. How much time did the price spend at the zone? The less time price spends at the zone, the more out of balance supply and demand are at that price level. This means smart money are aggressively entering. The first example is the strongest zone, with one bearish candle rejecting the area. The second one is a strong zone, with several Heiken Ashi inside the zone. And the third one is a weak zone, with many candles and a lot of time spent around this area. Number 3. The move away from the supply and demand level. Here, you analyze how far did the price move away from the zone before returning back around the area. The longer the distance the price moves away from the zone before returning to that zone, the greater the reward to risk and the probability. When price goes from selling off to a strong bullish trend, for example, there had to be a significant amount of buy interest entering the market, absorbing sell orders, and then driving price higher. Always look for extremely strong turning points. These are the high probability price levels. Number 4. Freshness of base. Number 1 rule in supply and demand trading: first time retrace to the base is the strongest to enter. If you trade supply areas, always make sure the zone is still fresh, which means that after the initial creation of the zone, price has not come back to it yet. Each time price revisits a supply zone, more and more previously unfilled orders are filled, and the level is weakened continuously. This is also true for support and resistance trading, where levels get weaker with each following bounce. The rules of supply and demand trading using Heiken Ashi are simple. You should buy when the price action approaches a demand level and bounces upwards, forming a green Heiken Ashi candle, ideally with no lower wick. You expect the price to increase and you want to trade an upcoming price swing. And you should sell when the price reaches a supply level and bounces downward, forming a red Heiken Ashi candle, ideally with no upper shadows. You would put a stop loss order right below the demand area when you are long in the market. Conversely, you put a stop loss order right above the supply area. The most common approach is to hold your trades until the price action reaches an opposite level on the chart. So if you are trading long on a demand level, you should hold your trade until the price action reaches the next supply zone on the chart. Or you could close a part of your position after Heiken Ashi color change. Now, how to define a trend using supply and demand and Heiken Ashi. Since we are primarily working with supply and demand imbalances on Heiken Ashi charts, making a higher high or a lower low doesn't necessarily mean the existing trend will continue. Here's my pro tip. In an uptrend, demand areas are being respected, supply areas are being taken out. So higher high should remove a previous supply to validate the demand zone. In a downtrend, supply areas are being respected and demand areas are being taken out. A lower low should remove previous demand to validate the supply zone. This type of analysis will help you a lot in defining the strongest Heiken Ashi supply and demand zones. In a downtrend, supply areas are consistently respected and demand areas are taken out. In an uptrend, supply areas are taken out while demand areas are respected. As simple as that. And another tip is to look at your daily or 4-hour chart and see what is going on with the supply and demand areas in control and decide which direction to trade. Once you know what direction you want to go, locate lower time frame supply and demand areas with a strong move away, little time at the level, and also a fresh level. Now it's important to understand that there can be several periods of accumulation during an uptrend and several periods of distribution during downtrends. This means that there are supply and demand reversal patterns and supply and demand continuation patterns. The drop-based rally is a bullish reversal pattern. The rally-based drop is a bearish reversal pattern. The rally-based rally is a bullish continuation pattern. And the drop-based drop is a bearish continuation pattern. This is important because understanding which phase the market is in, what is the underlying trend, and how long has it been in place. This determines which are the best demand and supply zones to look for. In an old trend, you want to look for reversals. In a new trend, you will want to look for continuations. You search for rally-based rally zones during uptrends and for drop-based drop during downtrends. And remember that every time frame has its own trend and multiple trends coexist. You may be trading in an uptrend on the 1 hour time frame, but the daily time frame is in a downtrend. So the first thing you need to do is to decide the time frames you will be using for a multiple time frame analysis of the trend. You need at least 2 time frames. When several time frames are combined to evaluate a market, you will easily improve the odds of success for your supply and demand trades, regardless of the other rules applied. This alone lowers risk, as there is a higher probability that the price action will eventually continue on the longer trend. As always, if you got any value from this and learned something new, drop a like to help us with YouTube algorithm, and make sure you click the bell icon to stay in touch when new videos are released. Until next time.